Hello, I am Dr. Shivaram Krishnan. This video is on making adjustments to the profit and loss account and the balance sheet. In this video, you will know about two key non-transactional items which impact accounting and thereby the financial health of a business. One of them is the unsold stock of saleable goods during a period, and the other is the decrease in the value of a fixed asset. The closing stock or inventory and the depreciation, as the two are known, are the two most important items which can be valued in different ways and therefore affect profit differently. After going through the video, you will be able to recognize the items which are beyond normal transactions but which impact profits. You will be able to value closing stock or closing inventory. You will be able to record closing stock in the profit and loss account and subsequently the balance sheet. You will also be able to value depreciation and then record depreciation in profit and loss account and balance sheet. We will look at some finer aspects of transactions. One important thing to be considered is all purchases which a business makes at a particular time may not be sold, which means that our enterprises may purchase shirts and all of them may not be sold during the particular period at which the summary of the transactions have to be made or the P&L account has to be made or the balance sheet has to be made. Now, let's take a transaction. Our enterprises purchased additionally 50 shirts for rupees 5,000 at an average price of rupees 100 per shirt. And subsequently, in the next transaction, it sold 25 shirts at the rate of rupees 150 per shirt for a total of rupees 3,750. Now, 50 shirts were purchased, but only 25 shirts were sold. So, at the end of a particular period, 25 shirts would remain as stock or balance. The cost price of these 25 shirts at rupees 100 per shirt would be rupees 2,500. Now, this rupees 2,500 is what is known as the closing stock or closing inventory. This is one of the most important items to be considered while recording the transaction. Closing stock always has to be verified physically. Most businesses would maintain a stock register to enter whatever comes in as stock and whatever is issued as sales. But despite the stock register, every business after a particular period ascertains what is the closing stock physically. And then the value of this closing stock also has to be ascertained. Here, of course, in our example, the value is closing stock rupees 2,500. Now, closing stock is not a transaction, unlike this transaction of purchases and sales. Therefore, how does this amount get impacted in the profit and loss account and the balance sheet? Let us see this. The sale value of 25 shirts is rupees 3,750. The purchase value is 2,500, and the profit on this purchase and sale is rupees 1,250. Now, we can represent it as follows. The sale value, add closing stock 2,500, the total becomes 6,250, reduce the purchases of 5,000, and still the profit is 1,250. How do these amounts get into the P&L account, or how can we show them in the P&L account? Now, in the P&L account, the purchases will increase by rupees 5,000 because of the purchase of additional shirts. The sales will increase by 3,750. Additionally, on the credit side of P&L account, we shall mention the closing stock as rupees 2,500. This automatically shows the profit as rupees 1,250. This is how closing stock is to be represented in the P&L account. So, we go back to the understanding. Closing stock is to be verified physically, the value is to be verified physically, and then the closing stock is entered on the credit side of the P&L account as closing stock. How, therefore, this impacts the balance sheet, and why should we consider that it should impact the balance sheet? Please remember, closing stock was not a transaction, yet we entered the term closing stock in the P&L account. So, one entry has been made in the P&L account. What about the dual aspect of that entry? We show that in the balance sheet. How do we do so? On the asset side of the balance sheet, we shall show closing stock as rupees 2,500. The cash balance on the asset side will reduce by a net of rupees 1,250. Why? Because we made a purchase of 5,000 on which there was a cash outflow, and our enterprises made a sale in which there was an inflow of 3,750. So, there was a net outflow of 1,250. So, this net outflow reduces the cash balance, and therefore, cash will be shown as less rupees 1,250 on the asset side. On the liability side, because the profit has increased by 1,250, the total of the profits will go up by rupees 1,250, and therefore, finally, the balance sheet will again balance. So, we continued the dual entry concept despite not making a transaction. It means closing stock is not a transaction, and therefore, this transaction was not recorded as a journal, yet we had to make an entry in the P&L account, and therefore we had to make an entry in the balance sheet also, thereby maintaining the dual entry concept. This is with the closing stock. There is another important aspect in a business, and this is called depreciation. Now, depreciation is one of the most important expenditures in a business without an outflow of cash. Recall that our enterprises purchased furniture rupees 20,000. Over a period of time, the value of the furniture will decline. Now, this decline in value is termed technically as depreciation. Depreciation is not a transaction in the real sense of the term. Businesses use several methods to calculate depreciation, which means a decline in a fixed assets can be calculated by several methods. Now, suppose we consider that there is a decline of 20% annually on the cost of the furniture. So 20% of rupees 20,000 will be 4,000, and this is annually. This is only a method we have outlined here. There are several other methods. Now, depreciation is a revenue expenditure, as is conveyance, as is refreshment. Or we say this is an operational expenditure. Obviously, where do we show this? This being an expenditure and a revenue expenditure, we show this on the debit side of the profit and loss account. So, on the debit side of the profit and loss account, we will show depreciation as rupees 4,000. And what will happen because of this? The debit side of the profit and loss account will go up by 4,000, and therefore when we deduct the debit total from the credit total, obviously the profit will come down by rupees 4,000. Now, when the profit comes down by rupees 4,000, this is only one side of the impact. The balance sheet has also to be impacted. So, what do we do in the balance sheet? In the balance sheet, we show the value of furniture as reduced by rupees 4,000. So, the original value of furniture is 20,000, less depreciation 4,000, and the amount to be taken on the amount column is rupees 16,000. So, when we look at the impact, profits have gone down by rupees 4,000. So, the value of profit will be shown on the liability side as 4,000 less. Simultaneously, on the asset side, the value of furniture goes down by rupees 4,000. Thereby, we maintain the balance of the balance sheet. So, the dual outlook concept continues to be maintained. These two important items have to be considered whenever we are recording the transaction and preparing the summary of these transactions to ascertain P&L account and to prepare a balance sheet. Closing stock and depreciation are two most important tools used by businessmen in order to adjust the profit or the assets of the business. You've seen this video, and let us see what the learning was. Number one, recognizing items which are beyond normal transactions but which impact profit. Identifying closing stock, how closing stock was recorded. You also learned that depreciation is the decline in the value of a fixed asset over a period. You learned how depreciation is recorded as a revenue expenditure or an operational expenditure in the profit and loss account on the debit side. And you also learned how both closing stock and depreciation were shown in the balance sheet.